Welcome to this week's edition of the Monocle Banking Podcast, curated by Monocle Solutions. And I just cannot believe that this is the final episode of the year. Where's all the time gone? Well, we don't just skim the financial headlines on the show. You'll know we dig in like a kid in a candy store, or maybe a kid just before Christmas. Except in this case, the candy is actuarial tables, liquidity stress tests, and the sweet promise of regulatory reform. Today, we're taking a closer look at Deloitte Africa's freshly baked 2024-25 Africa Insurance Outlook. It's a report packed with insights and one that is certainly opening up interesting avenues for debate around insurance. Joining us to decode this tome of industry trends, regulatory pivots, and technological teasers is none other than Andrew Warren, Deloitte's insurance leader for Africa. If anyone can make liquidity, risk governance sound exciting, or at least understandable, it's him. So buckle up for a journey through legacy products, climate change dilemmas, and why insurtechs might just be the most exciting thing to happen to insurance since the invention of the actuarial spreadsheet. Well, Andrew, welcome to the show. It really is great to have you on this concluding podcast in what has been a very busy year. Firstly, tell us a little bit more about your personal and professional journey and what attracted you to the insurance sector.
So thanks, Michael. I'm an actuary by training. Actually, in fact, my grandfather was also an actuary. So my mother introduced me to the profession. And I joined Old Mutual as a bursary student many, many years ago and have cut my teeth in the industry ever since. I'm cutting through companies, consultancies, and a whole lot of activities along the way.
Well, I guess you've heard all of the actuarial jokes, so I'm going to try and keep those to a minimum. But it's a very, it's one of those professions. Obviously, you've got to do well in maths. You've got to really enjoy that kind of problem solving. But it's one that when you start working, opens up a really interesting dynamic in financial services in that you really help model and understand the future. And I'm often reminded of what Ray Dalio says about those who live by crystal balls. You end up eating broken glass. But actuarials don't tend to do that. They get it right more often than not. Well, how have you found the profession so far from a perspective of fulfillment and personal satisfaction?
At a personal level, the profession has been amazing. It's given me opportunities to, use my, as you say, good mathematical capability that I had coming out of school. But more than that, I think the actual profession trains problem solving. And so it's actually around complex problem solving, looking at a number of different elements, both financial, statistical, and socioeconomic, to actually give advice or solutions to the insurance industry. And for me, the insurance industry is sort of an extension to the social security industry, actually. We protect people's livelihoods, people's goods when they least can afford to. And that's what the actuaries do. They make the financial sense of this and make sure that the industry is stable and able to thrive in the uncertainty that insurance is.
And insurance is so important to so many things. I mean, it's not one of those things. I referenced it in my introduction. For many people, buying insurance, if it's short term, if it's life insurance, it's not something, and they often say it's not something you go out and you buy, it's sold. But because it's not a sexy part of the world of finance, but it's so important. It ensures that as you accumulate assets through life stages, that those assets are protected and therefore builds financial resilience. And it helps deepen financial inclusion and ensure that more people can actually hope to have a chance of ensuring that the next generation don't have to bear the burden of previous decisions that were taken. And in fact, I think when you look at it, it's one area where we could have a long debate around making things like third-party insurance mandatory to make it cheaper and to be more inclusive. But I want to come back to the report. And it's a very interesting report that notes that South African insurers have demonstrated a very famed South African characteristic, resilience, like the Springboks winning by consecutive 1-point victories in World Cups, despite all of the economic headwinds and inflation and interest rates being high. Beyond the operational efficiencies, how have insurers in general adapted their pricing models and underwriting practices to ensure this resilience?
So as you say, our report, this is our fifth year of the report, we've looked at the market. I think we're still seeing the overhang of a couple of things that happened from 2020, those infamous years of the 2020s. COVID is still with us to some extent, as are some of the short-term insurance catastrophic events, some of the floods and some of the social unrest that happened through that period. And I think the industry has maintained resilience mainly through the fact that their capital is well managed. And for the most part of it, the ability to use that capital to support the additional claims and use their strong balance sheets to deliver on the promises of insurance is really what has held them in good stead all the way through to 2023. And then if we look at this year has been really a really good year for the insurers, particularly on the investment side. Part of the insurance operations are the actual doing the insurance products. But a lot of it is the return on the capital and the return on the assets that they're holding. And this year has been a good year in the markets for asset investors. And that helps the clients and the insurers through this year.
And as we know, markets have done exceptionally well. It's the insurance model. You pull the risk and you take those premiums, you invest them as well. And if you look at it, the Prudential Authority has emphasized that liquidity risk management through stress testing frameworks is important. How are insurers balancing the dual pressures of meeting those regulatory liquidity requirements while optimizing their capital allocation for growth?
So yeah, this is something that the regulator has been looking at for a while now. That's part of the fact that the prudential regulator is looking at both banks and insurers. And your listeners will appreciate the liquidity requirements of banks is paramount to bank stability. But they're also looking at making sure that the insurers are also watching the liquidity requirements that they have. The actual processes look at the capital requirements a lot. They look at making sure that the overall balance sheet is strong. But it's important that the insurers can pay claims when they need to and that the insurers have got access to liquid assets when they need to pay those claims. So the regulator is taking a look at what they need to do. They're taking a very measured approach to this. They're engaging quite extensively with the insurance industry. But it is going to require a little bit of extra reporting to the regulator and a little bit of extra diligence around some of the risk measures that insurers need to look at. And it was actually interesting during COVID, a couple of the insurers did take a better look at their liquidity environment and have made some changes already. So I think it's an evolution of good risk management for the insurance industry.
Is there a risk here that liquidity-focused stress tests could inadvertently create a conservatism that might stifle innovation or market expansion?
In our discussions with insurers and with the regulator, I think the regulator is taking a measured approach, and I don't think that the requirements will be overly burdensome. That'll take away the innovation that is inherent, particularly in the South African insurance market.
And it was quite interesting to see, certainly from a pricing perspective, what happened through COVID. Many of the big life insurers implemented a once-off extraordinary price increase because of the impact of COVID on their modelling and their actuarial mortality tables. That then, after COVID, returned to the mean or to the normal, in inverted commas, levels, but there hasn't been an extraordinary price decrease. Do you think the industry is getting away with one here?
So I think it's different for different product sets. I think the retail insurance product, those price increases weren't significant. I think a lot of those the cost increases of extra mortality were absorbed by the fact that policyholders were keeping a hold of their policies a little bit longer. So the lapses were down. And so those products have maintained their price point. In the annually priced product, particularly the ones in the pensions space, that's where the prices did go up a bit. But we are seeing pressure on those prices coming through, and the insurers in their statements to the market are indicating that the market is softening as the brokers are looking to get better deals for the pension funds with their group life cover. So we do expect those prices to, let's call it, normalize in a much more competitive market, which is what the pension fund group life market is.
Absolutely. It certainly came through in some of the recent operating results as well, a mention of this, and I know Alex Forbes has been quite vocal on trying to put a bit of pressure on the industry to say, right, guys, it's time to normalize since the post-COVID experience hasn't been, thankfully, an increased mortality. Now, if we look at the implementation of various accounting standards, IFRS 17, talk to me about this. It's significantly altered financial reporting, particularly with the introduction of the contractual service margin, the CSM. How has this change influenced the strategic decision-making of insurers, especially regarding their product design and how they engage customers?
So just as a bit of background for your listeners, this is a reporting standard that the International Accounting Standards Board has put in place to standardize the way that insurers globally report on the performance of their activities to shareholders. It's been a pretty long journey, and the insurers, I think, are a little bit frustrated for how long it took. And this contractual service margin that you refer to is really just a measure of profit that is captured in a long-term contract. So it allows the users of the financial statements just to see how much value is created year on year by the insurers. In terms of how it's impacting on the strategy, I think this is new territory for a lot of the insurers in terms of the new reporting standard. And a lot of them are still relying on older performance metrics like embedded value, which your listeners who are aware of the metrics that the insurance industry use are key for understanding value and value creation. Over time, the insurers will look to understand these new metrics better and be able to make pricing decisions and capital allocation decisions in a more consistent way. So I personally do see some evolution over time, but it's still too soon for insurers to understand how these new performance measures respond to both market movements and changes to product performance. And so we'll wait and see for the next couple of years as to how they respond. But what they are really pleased about is that the overall regulatory pressure from the accounting regulators and the prudential regulators is slowing down a little bit and is giving them a little bit of space to invest a little bit more in product development, in distribution investments, and digital enablement capabilities.
You mentioned in the report that Ghana's National Insurance Commission provided tailored training and templates for this IFRS 17 adoption. Are there lessons that South African insurers could take from this, particularly in creating capacity among smaller insurers who might lack some of the resources as some of their bigger competitors have during the transition?
So it has been a big burden on the smaller insurers. I do think that the South African insurers have had a bit of an advantage relative to our East and West African colleagues because of the introduction of the prudential regulations that were put in place a few years ago. So the prudential regulations in South Africa mirrored the regulations that were in the EU and the UK. And the underpin of those was very similar to what the accounting standards required. The Ghanaian industry, the Nigerian industry, the Kenyan industry are still on a slightly earlier version of the capital regulatory requirements, which has meant that the need for additional training and additional support by the regulator to support the accounting standard implementation has been something that they've leaned into. And has been really important to make sure that they've been able to transition to a global standard while their regulators have been catching up to more mature capital frameworks.
Are there any signs yet that the IFRS 17's implementation has begun to foster greater transparency and comparability across African markets, or is it still too early to tell?
It's a little bit early to tell, but if I think about the discussions I've had with the investment analysts, they're starting to see the bits that can be compared and the bits where they have to dig in a little bit deeper. I do think that some of the preparers in South Africa have put some very good analysis together around how each of the individual product lines have performed and how they've performed relative to each other. That is giving an indication of how this will evolve. Globally, we have seen the global listed insurers using this a lot more than our local insurers. And I think that's because a lot of their frameworks were quite disparate across the market. So I think it is a matter of time, and we will see this evolve through time.
Yeah, one thing that always amazes me about insurance is how it's approaching technology. And I think there's certain areas where I think InsurTech is absolutely primed to make maybe the customer claims process a lot easier, much more intuitive, uploading pictures and that kind of thing. But I do think the insurance industry structurally isn't as well placed as, say, the banking industry to engage with customers because we don't engage daily, ideally, with our insurers. You know, it's at a particular event that you might have to, being onboarded or at claims, versus opening your app for banking, which we all pretty much do daily, which I certainly do at this stage. What are you seeing in the insurtech space? And when it comes to integration and market penetration, there's been, different strategies. Some have partnered with fintechs, others have trying to go alone. We've seen startups like Beamer and Pineapple using mobile technology. What are the big trends that you're seeing in this space?
So I think you've described it quite well. I think there are a couple of strategies. Some of the newer market entrants with specific products, sort of single product sets are the ones that are coming in with what would be labeled an insurtech underpin. So very much a digital transaction environment, a digital interaction environment. As you say, Pineapple, Beamer, Naked are good examples of those. And those are making good headway, particularly in the short-term insurance space, which can be more transactional and you are interacting with your contract or your product on a slightly more regular basis, particularly as people are becoming more and more aware of the price of insurance and are going in for annual renewals and actually negotiating better terms. In the life insurance space, slightly different, but still with insurtechs in mind, the insurers are using digital and insurtech platforms to be able to do component parts of their product life cycle. So some good technology in the underwriting space, where technology and optical recognition can actually speed up the underwriting process, where the intermediary is digitally enabled to have a much better conversation and a much quicker advice process with clients, is what's happening in the life insurance and savings space. So quite a broad set of activity happening, but definitely, the key thing for the insurers is to get a lot more efficiency in the process and a lot better customer experience of what you describe as potentially quite a cumbersome and foreign transactional process for a lot of consumers, particularly those entering the insurance market for the first time.
Yeah. And for a while, there was this idea that you don't want to exclude older or less tech-savvy customers, but my mom can use 60/60. So I think those ideas are almost antiquated if we look at how digitally native we've all become. The report does mention generative AI as a potential game changer for underwriting and claims management. What are the specific use cases that you see for AI that hold the most promise for the African insurance sector?
This is something where, I think speaking to one of the new insurers recently, and while ChatGPT came to the market 2 years ago, they've been using the equivalent of that for 3 or 4 years. And that's in the onboarding and underwriting process, where they've got a sort of very few humans in the loop process, as well as in the claims process. So very much in the short-term insurance, particularly the retail short-term insurance space. The other areas around AI and generative AI is around the specialist insurers looking at ways to map and model risks more effectively and being able to use large data sets to be better at risk identifying and risk managing big portfolios of business. So it's, once again, the new entrants can come in and put it all the way through their value cycle. The larger insurers with the more specialist insurance books will be using it at very specific environments to be able to enable the intermediaries, the brokers, the end user to have a much better experience.
And it's incredible. I mean, we've obviously only really started engaging, to your point, with ChatGPT recently, but how long this technology has actually been in the marketplace and how it's being implemented. With the pace of AI adoption varying significantly across insurers, is there a risk here of creating a digital divide within the industry where only the most resourceful or innovative players thrive?
So resourceful, yes, and not least innovative, yes. Resourceful, no. I don't think it's a matter of capital. I think there's enough capital in the market, whether you're a small upstart or an established player. I think it really does come down to the way that the business is constructed and the way that the legacy of the organization can be scrubbed to allow for newer approaches and newer ways of doing work with customers.
Well, that is interesting. I know, chatting to Johan van Grenning recently, the CEO of Standard Insurance, that they're increasingly using geo-mapping, geocoding technology because of the impact of severe weather and the increase in weather events, be it floods in KZN, fires along the Eastern Cape over the last 5 years. It's definitely strained the industry. How has this affected the way that insurers approach underwriting? Because this is a very interesting area. You just look, for example, of what's happening in Florida with the increase in very severe hurricane events. There's some talk in that region of homeowners insurance becoming unaffordable.
This is definitely something we're looking at. We looked at it in the outlook as well, is around the impact of changing environmental risk to insurers and how the insurers need to look at it both from a risk management perspective, which is how this new environmental risk actually impacting on their own ability to take risk and pass risk between people, as well as what they can do to make sure the risk is minimized and how they actively involve with society to make that happen. We actually had a debate a week or two ago at the actual conference around this and the impact of the removal of cover from vulnerable areas. And it's actually interesting enough, something that the Financial Services Conduct Authority is actually watching quite carefully in terms of the viability of insurance in those areas and making sure that we don't land up with actually an uninsurable set of communities because of what's happening from an environmental risk. And the insurers are taking this on, and in particularly the reinsurers are also taking it on to make sure that they're not part of the problem and that they're the ones who provide the ultimate cover. And they really are working with government, with the regulators, with the insurers to create a viable and sustainable insurance industry.
It's a big challenge. From where you're sitting and from a cost perspective, how does the industry balance pricing to account for extreme weather? And how do you see those costs being shared fairly among consumers, insurers, and reinsurers?
Tough one. I think the key thing here is to have a look at how wide you spread the risk pool and making sure that the customer is part of the solution. I think one of the things that is happening in terms of managing particularly things like flood risk and some of the emerging risks is actually to work with the policyholder to make sure that their properties are better protected. I think some of your listeners might be aware of the SMSs that get sent around to some customers of insurers with their car insurance to go and park their car under cover when hail is coming.
Yeah.
Engaging with the local municipalities to make sure the drain waters are cleared, because some of the flood damage is actually a consequence of lack of maintenance of infrastructure. And so it's an ecosystem play rather than an individual problem to be solved by just the insurer. And if we look at the way that South Africa Inc. are responding to the broader socioeconomic pressures in terms of business unity and the engagement with government, I think this is the blueprint for how things are actually starting to work, and we're solving the problem collaboratively and together.
And it's great to see that kind of public-private partnership in action. It's a real use case, tangible use case of how this is evolving. You also looked at sustainability broadly and ESG integration and highlight the opportunity to align insurance products with the sustainable development goals. You've got affordable energy, you've got climate action in there. What are the kinds of frameworks that insurers can use to measure and communicate the impact of these SDG-aligned products to all of their stakeholders in keeping with this theme around the role that they're playing with government here to help alleviate the risks on the end policyholder or user? I'm not seeing a lot of communication from my insurer. I know it's a very unscientific study of one, but do you think more could be done?
So more can be done, but a lot is being done. I think the place to look for these kinds of things is in the integrated reports of the insurers. And I think that the insurers that we've spoken to are not seeing significant value right now in terms of communicating directly with the end consumer. I think the end consumer is more worried about coverage and price, accessibility, and those things. They are starting to become much more aware of the societal impact that the insurer plays. But in the integrated reports, the extent to which insurers are looking at the carbon footprint of the companies and the products that they're insuring, looking at the investment footprint of the investments that they're holding is all part of the broader sustainability reporting framework. And more, the South African insurers are voluntarily signing up for this. The European insurers are mandated to do a lot more of this reporting. But by starting the reporting journey, the organization becomes much more aware of their impact beyond just the normal, let's call it the buying green products in colloquial terms, but actually the insurance footprint and the way that they're actually insuring and changing the behavior of their clients starts putting that societal change into play.
What we still see, though, is large underinsurance in Africa, particularly. In fact, globally, I think there's an underinsurance problem, but it's acute in Africa. We've got this very youthful demographic in the continent, which obviously offers vast potential for insurance penetration. But you get the sense that potentially insurers are not designing products that align with the financial realities and the cultural behaviors of maybe a younger digitally native customer, but also a customer that is in the African context, maybe used to working in gig economy type roles and jobs. And do you think there's a huge opportunity, there must be here, for the insurance sector to relook at the way it designs products? And I just think here of funeral policies. You chat to that demographic and there is an overselling of funeral policies. So there's an understanding that we need cover for when we die. Why are we not seeing penetration in this market, and what can be done to improve inclusion here?
This is a multifaceted discussion, but we could take a podcast in its own right. But I think part of it is, as you say, it's cultural and the cultural norms around bereavement and that time of loss. But the other thing I think is around just the general awareness of insurance, particularly in East and West Africa. The trends we are seeing, though, is that the brands that are starting to play a very big role in insurance, particularly in East and West, and we're starting to see it in South Africa as well, are actually not the insurance brands, but actually the mobile network operators and the retailers and other affinity players. And I think this is where the insurance industry is playing a role, using, as we were talking earlier, technology-enabled embedded insurance products inside things like cell phones, being able to do occasional insurance rather than contractual insurance. And these are starting to take off in the likes of Ghana and Kenya, to be able to create a more micro-insurance environment that people become much more aware and comfortable that the promises that are being made by the insurers are going to be met, and then become adopted more. And the other thing is, as the economy grows and more asset accumulation happens, asset protection becomes a critical element. So it really does link very much to the economic growth. As the economies grow, the need to protect one's goods, protect one's family, becomes a critical solution that the insurers can solve. And with that comes the growth and the growth of the penetration.
I'm going to have you back on in the new year, Andrew. You led with the chin there, and we'll just talk about this issue. I'll see if I can get Johan on as well, because it's a very important issue and one that I think could drive the next leg of growth. On that point, and just as a concluding gaze into your crystal ball, what do you see as the big 1 or 2 or 3 things that are going to drive growth in the insurance industry in South Africa and broadly in Africa in 2025?
So 2025, I think we need to see confidence in the market. We need to see a little bit of relief from the inflation, which we are starting to see, and then a little bit more disposable income. I think the key thing for the insurers is to be able to tap into the disposable income that will hopefully grow into the new year, and the confidence that has come with the changes that have happened since the middle of the year. I think the insurers are all reaching for scale. If we look at what's happening, they're scaling up their operations. They're making sure that they've got much better focus on interactions with customers. And I suppose a lot of them, if we look at the South African market, are playing what would be called the Capitec defensive game. Capitec has done an incredible job at building a very, very large insurance operation. And I think that's keeping all the insurers on their toes to be delivering better product and delivering good outcome to customer. And I think similarly in East and West, the economic growth will continue to come through, and the insurers will continue to invest in good distribution and good product.
And that, dear listeners, is the final episode of the Monocle Banking Podcast for 2024. As we wrap up the year, we've unpacked trends, we've tackled challenges, and hopefully we've sparked some new ideas in the dynamic world of finance and insurance. A heartfelt thank you for being part of this journey so far this year, for your listens, for your shares, and for your continued curiosity. Here's to more in 2025. To Andrew Warren and all of our incredible guests throughout the year, thank you so much for sharing your insights and your time as well as your expertise. Together, we've explored everything from a liquidity stress test to the bold possibilities of insurtech, proving that no spreadsheet is too dense and no idea too lofty to examine. As we bid farewell to 2024, we wish you a joyous festive season filled with lots of relaxation and reflection, and perhaps just a bit of regulatory reading, if that's your kind of holiday fun. Here's to a prosperous and innovative 2025. Until we meet again, take care, manage your risks wisely, and keep dreaming big. This is me, Michael Avery, signing off for the Monocle Banking Podcast. We'll see you early in the new year.